Imagine you are holding a massive, glistening ice cube. To you, it represents wealth. You have been told that as long as you hold this ice, it will drip cool, refreshing water into your glass every single hour. That is your passive income. That is your 6 or 7% dividend yield. You feel smart because while others are out working for their water, yours is just appearing. But there is a catch you chose to ignore while looking at that beautiful drip. The ice cube itself is melting. Every time a drop of income falls into your glass, the core of your wealth gets smaller. Eventually, the structural integrity of the cube fails. It cracks, it shatters, and suddenly the dripping stops. You are left with a half-empty glass of water and no more ice. This is not just a metaphor. This is the mathematical reality of chasing high-yield dividend stocks that the market has already marked for death. I am Tom, and I spend an unhealthy amount of time reading financial reports, so you do not have to. Today, we are dissecting a trap that catches some of the smartest people I know. It is the lure of the 6% yield. On paper, it looks like a retirement dream. In reality, it is often a distress signal. If you can give me the next 20 minutes, I promise it will be the best ROI on your time this week. We are going to look at why a fat dividend is often just a symptom of a dying business, and how you can spot the difference between a real cash cow and a sacrificial lamb. If you find this kind of deep dive useful, you might want to consider joining the optimizers. Just click that join button below. Our members get priority in the comments and some pretty cool custom badges, but more importantly, they help keep this channel independent so I can keep telling you the truth about these yield traps without a broker whispering in my ear. Let's start with a hard truth that most dividend investors hate to hear. Dividend yield is a mathematical output, not a generous gift from a CEO. Think back to the basic formula. Your yield is just the annual dividend divided by the share price. That is it. It is a simple fraction. Now, if you want that fraction to get bigger, if you want that yield to jump from 3% to 6%, only two things can happen. Either the company suddenly decides to double the amount of cash they send out, which almost never happens, or the share price falls by half. When you see a stock yielding 7 or 8% in a world where the average S&P 500 company yields less than 2%, you are not looking at a bargain. You are looking at a denominator problem. The stock price has cratered because the market sees something you might be missing. The yield is high because the business is failing, not because the management is generous. I like to think of a high yield as a warning siren. If you see a house for sale at half the price of every other house on the block, you do not assume the owner is just a nice guy. You check the foundation. You look for mold. You ask if there is a highway being built through the backyard. But for some reason, when it comes to stocks, we see a 6% yield and our brains shut off the critical thinking department. We start thinking about the beach and the passive income. Research from Plato Investment Management makes it very clear. A high yield is usually a reflection of a falling stock price. And why do stock prices fall? Because the market expects earnings to drop. If earnings drop, the company's ability to pay that dividend eventually disappears. You are essentially betting that you are smarter than the collective wisdom of the entire market. Sometimes you are, but more often than not, that yield is high because the dividend cut is already being priced in by the professionals. Morningstar has done some incredible research on this, and their rule of thumb is something I always keep in the back of my mind. In today's economic climate, if you see an equity fund or a stock with a yield greater than 7%, it is probably distressed. That is a heavy word. Distressed means the business is under significant pressure. It might be drowning in debt, or its main product might be becoming obsolete. When a yield is that far above the market average, it is no longer a stable source of income. It is a risk signal. High yield strategies tend to be much more volatile because they are effectively a collection of companies that the market has lost faith in. You might get a few years of nice checks, but you are sitting on a powder keg. If the overall market is yielding 2% and you are chasing 8%, you are taking on 4 times the income risk without even realizing it. The stability you think you are buying is actually a mirage. We have to talk about the psychology of why we fall for this. It is the free money fallacy. We look at the dividend check as separate from the stock price. I have seen investors watch their principal drop by 20% while saying, "At least I got my 6% dividend." Let's do the math on that for a second. If your $10,000 investment loses $2,000 in value, but pays you $600 in dividends, you have not made money. You are down $1,400. You have just liquidated a portion of your own capital and paid taxes on the privilege. It is like taking $100 out of your left pocket, giving $15 to the government in taxes, and putting the remaining $85 in your right pocket, while telling yourself you just got a raise. The trap is fixating on the income line while ignoring the balance sheet. If the business is not growing, the dividend is just a slow-motion liquidation of your own investment. And trust me, the market will realize it before you do. If you think losing a bit of principal is bad, wait until you see the opportunity cost. Most people stop their analysis at the dividend yield and think they are being conservative. But I'm going to show you how a safe-looking 6% yield can actually leave you with half the wealth you would have had in a boring index fund. This is where conventional wisdom says to stay the course for the income. But I'm going to tell you why that course might be leading you off a cliff. We are about to look at the double whammy, the moment where the income drops and the capital crashes at the same time. If you have ever wondered why some dividend ETFs have negative returns over a decade, despite high yields, this next part is for you. We are going to look at a real-world example that might make you want to check your portfolio immediately after this video. Let's walk through the life cycle of a dividend trap. It usually starts with a solid, older company. Think of a legacy retailer or a telecommunications giant. They have been paying a dividend for 20 years. They are proud of it. But the world changes. Competitors arrive. Margins shrink. The stock price starts to slide because growth has evaporated. As the price falls, the yield starts to look juicy. It hits 5%, then 6%, then 7%. New investors, lured by the yield, jump in thinking they found a bargain. They think the price drop is just a temporary market overreaction. But the business fundamentals are still deteriorating. The company is now paying out 90% of its earnings just to keep the dividend alive. They aren't reinvesting in the business. They aren't innovating. They are starving the future to pay for the present. This creates a fragile state where any minor economic hiccup becomes a catastrophe. The trap is now set, and it is waiting for a trigger. When the dividend cut finally happens, it isn't a quiet event. It is a double whammy that hits your wallet from 2 directions at once. First, the income you were counting on drops. Maybe they cut it by 50%. Now your 6% yield is a 3% yield. But that is actually the smaller problem. The bigger problem is the market's reaction. A dividend cut is a formal admission by management that the business is in trouble and the future is bleak. The institutional investors, the big pension funds that were only holding the stock for the yield, all rush for the exit at the same time. The stock price doesn't just dip, it plummets. I have seen stocks lose 30% of their value in a single afternoon following a dividend cut. So now you have less income and a significantly smaller pile of capital. You bought for the 6%, but in the end, you lost 30% of your principal to get it. That is the trap springing. It is a brutal lesson in why yield without safety is just a gamble. If you want a real-world example of this, look no further than the Global X Super Dividend US ETF, ticker symbol DIV. On the surface, it sounds amazing. It targets the highest yielding stocks in the country. If you love dividends, this looks like the promised land. But let's look at the actual 10-year numbers. Over a decade, the share price of this ETF fell by nearly 30%. Think about that. Even if you were collecting a 7% dividend every year, your initial investment was shrinking by 3% a year on average. When you add it all back together and subtract the fees, the total return over 5 years was only about 4.4% cumulative. Not per year, cumulative. Meanwhile, the broader market was making double-digit returns almost every single year. You were taking on the risk of individual high-yield stocks and getting paid less than a basic savings account might have offered in certain periods. It proves that focusing exclusively on yield is a recipe for massive underperformance and capital erosion. It is the perfect example of chasing the drip while the ice cube melts. There is a dangerous psychological trick people play on themselves called yield on cost. They say, I bought this stock at $50 when it paid a $3 dividend, so I have a 6% yield. Even if the price falls to $20, they still think they have a 6% yield because they are looking at their original purchase price. But the market doesn't care what you paid. If that dividend gets cut from $3 to $1, your actual income has evaporated. The value of your asset has collapsed. Thinking about what you paid years ago is a form of anchoring that prevents you from seeing the current danger. If you wouldn't buy the stock today at its current price and current prospects, you shouldn't be holding it just because the historical yield looks good on your spreadsheet. You have to be cold-blooded about this. Every day you hold a trap, you are choosing to lose money. The income is not a shield, it is the bait that keeps you from selling a dying asset. If you think those numbers are scary, wait until you see what happens behind the scenes of these companies. Most investors look at earnings, but the real pros look at something much more telling. We are about to dive into the red flags that scream dividend cut months before it actually happens. If you ignore these two specific ratios, you are basically flying blind into a storm. We are also going to look at certain sectors like REITs and BDCs that are designed to pay high yields but carry a secret leverage risk that can wipe you out in a recession. Before we get to the solution and the exact protocol I use to screen for these traps, we need to understand the structural rot that causes the melt. If you have been eyeing any stock with a yield over 6% lately, this next part might just save your retirement fund. The first thing I check when I see a high yield is the payout ratio. This is simply the percentage of earnings a company pays out as dividends. For most healthy, mature companies, the sweet spot is between 35 and 60%. This is the Goldilocks zone. It is enough to keep investors happy, but it leaves plenty of cash for the company to reinvest, pay down debt, or weather a bad year. When you see a payout ratio climb above 80%, you need to start worrying. It means the company has no margin for error. If their sales drop by even a small amount, they will be forced to either borrow money to pay the dividend or cut it. A company paying out 100% of its earnings is essentially a zombie. It is not growing, it is just existing to service its shareholders until the cash runs out. If you see a high yield combined with an extreme payout ratio, you aren't looking at an investment. You are looking at a countdown clock. But here is the twist. Sometimes earnings lie. Accounting rules can make a company look profitable on paper, even when their bank account is empty. That is why I always look at the free cash flow payout ratio. Earnings are an opinion, but cash is a fact. Free cash flow is what is left over after the company pays for all its operating expenses and capital expenditures. This is the actual cash available to pay you. If a company is paying out more than 100% of its free cash flow as a dividend, they are funding your check by selling assets or taking on new debt. That is the definition of unsustainable. It is like a family paying for a luxury vacation by putting it on a credit card they can't afford to pay off. It looks great on Instagram, but the bankruptcy lawyer is already in the mail. If the cash flow doesn't cover the dividend, the dividend is a lie. Always check the cash flow statement before you trust the yield. We have to talk about specialized structures like business development companies, or BDCs, and REITs. These are often the darlings of dividend chasers because they frequently offer 9 or 10% yields. By law, these companies have to pay out 90% of their taxable income to shareholders. This sounds great, but it creates a structural trap. Because they pay out almost everything, they have no internal buffer. They can't grow using their own cash. They have to constantly issue new stock or take on more debt to expand. This makes them incredibly sensitive to interest rates and the economic cycle. During the 2008 crash, many BDCs saw their values drop by 30 or 40% because they were highly leveraged and their income sources dried up. You are getting a high yield, yes, but you are also acting as a high-risk lender to small businesses or commercial real estate. In a booming economy, it feels like free money. In a downturn, those 10% yields can vanish overnight, along with a huge chunk of your principal. A lot of people hide behind the term Dividend Aristocrat to justify chasing yield. They think that because a company is on that list, it is safe forever. But real dividend aristocrats, the ones in the S&P 500 index, usually don't have 7% yields. In fact, they usually yield between 2 and 3%. Why? Because they are high-quality businesses that the market values highly. The price stays up because people want to own them. The actual S&P 500 Dividend Aristocrats Index has historically outperformed the broad market because it focuses on dividend growth and quality, not just the current yield level. The trap is using the aristocrat mindset to justify buying a company that has a high yield simply because its price is collapsing. Real wealth is built through dividend growth, where the company increases its payout by 7 or 10% every year. That is what drives the stock price up over time. Chasing a static 6% yield while the business decays is the opposite of the aristocrat strategy. Let's put some hard numbers on this so you can feel the impact. Scenario A. You buy a high-yield stock at 6%. Because the business is struggling, the stock price drops by an average of 4% every year. At the end of the year, your total return is only 2%. Now, compare that to a boring S&P 500 index fund that yields 1.5% but grows at 8% a year. Your total return there is 9.5%. Over 10 years, $10,000 in the 6% trap grows to about $12,000. In the boring index fund, it grows to over $24,000. By chasing that extra 4.5% in immediate income, you literally cost yourself $12,000 in wealth. You paid $12,000 for the privilege of seeing a slightly larger check in the mail every quarter. This is the hidden cost of the dividend trap. It isn't just about what you lose, it is about what you fail to gain. Capital appreciation is the engine of wealth, and a high dividend is often the brake that slows it down. So how do you avoid these traps in practice? I use a simple 4-step protocol. First, any yield over 5% gets an immediate red flag. It doesn't mean I won't buy it, but it means I'm going to spend 3 times as much time researching it. Second, I check the payout ratio across both earnings and free cash flow. If both aren't under 70%, I'm usually out. Third, I look at the 5-year dividend growth rate. If the dividend is flat or shrinking while the yield is high, that is a classic trap. A healthy company raises its dividend because it can, not because it has to. Finally, I look at the total return over the last 5 and 10 years. If the stock has a high yield but a negative price return over a decade, it is a shrinking ice cube. Do not be the person trying to catch the drips while the core is melting away. Stick to the boring middle, moderate yields, low payout ratios, and consistent growth. We have covered a lot of ground today, from the math of denominators to the structural risks of BDCs. But the real test is in your own portfolio. I want to turn this into a bit of a peer review session. If you are eyeing a specific high-yield stock or ETF right now, maybe something yielding over 6%, Drop the ticker symbol in the comments. I will try to jump in and run the payout ratios and 5-year total returns for as many as I can. Let's see if we can spot the traps together. And remember, if you want to make sure I see your comment and get a faster response, becoming a member of the Optimizers is the best way to do that. It helps me prioritize the people who are truly dedicated to mastering their money. The goal isn't just to get a check in the mail, it is to build a pile of wealth that actually lasts. Don't let a flashy yield sign lead you into a dead end. Stay curious, keep running the numbers, and I will see you in the next one.